Hello and welcome to my next video. Very important macroeconomic measurement has to do with the national income and product accounts. It's all about GDP, gross domestic product. And before we get there, though, I want to conceptually talk about how we can think about GDP in terms of why we come up with the components that we do. And that model that helps us understand that is the circular flow. So let's look at a very simplified circular flow. So what we're seeing here is two markets, the product market and the factor market, and two different entities, households and business firms. So product markets, that's where businesses come and bring their products. Now, obviously, it'd actually be goods and services. Sometimes you'll see this called the goods market as well. And so that's represented by the cylindrical shape here. And so they're bringing their goods and services. And this is we're assuming this is in a market oriented economy. Households in an economy that uses money, which all modern ones do, and let's just say the United States, they bring their dollars. They decide on how much they want to purchase of the products, and then those products flow to the households. And so that's the cylinder over here. So the dollars are flowing this way to the product market from households and then on to business firms. Well, several things. One is, how do the business firms make those products? Well, they have to purchase resources or factors of production. Those factors of production: land, labor, capital, and entrepreneurship. That's mentioned in another video. And so they're purchasing those factors. Well, you say other businesses usually own land, labor, capital. Well, ultimately, though, all businesses are owned by whom? By people. So ultimately, households, we can think of this as consumers, households own all the factors of production. And so they offer the factors of production, land, labor, capital, that's the smiley face, to business firms at the factor markets. Now, these markets could be physical locations, it could be over the internet, it could be whatever. Business firms bring their dollars, where they get the dollars from making the sales, or in startup, they have outside monies coming in, or outside partners or whatever. So they bring their dollars and purchase the amount of resources, the factors they need, and then those factors are flowing on. So notice that the flow of dollars goes in a circular fashion, and the flow of actual stuff goes into a circular, counterclockwise, if you will, fashion. So the basic players in a market economy would be demand. That's, for the most part, we're talking about product markets. Demand would be consumers, households. Suppliers would be the business firms. That's in the product markets. And it's just reversed down in the factor market. So demand would be business firms purchasing factors, land, labor, capital, and suppliers would be the households. Now, I hope you can see this is, a good analogy would be pipes of water flowing or electrons in a circuit. So anything that's flowing, this is a circular flow, it's called. If it's flowing in a circular pattern, again, depending on if you're talking about the physical things or the dollar bills, which way they're flowing. But one thing that should be obvious is the dollar value of the actual green pieces of paper. Again, I know it's nowadays not a whole lot of green pieces of paper, but think of it that way. The green pieces of paper, the value has to exactly equal the value of the resources down here in the products. So these are equal value physical things in dollars. Another thing that has to be true is if this circular flow is maintaining the same flow, by definition, then the flow up on the top part has to equal the flow on the bottom part. So that'll be important in some of our analysis later on. Now, this is highly, highly simplified. Obviously, this is not a real world economy. But when we get to a more real world economy, it does get pretty messy. And so, in order to cut down on some of the messiness, I'm mainly just showing the direction of the arrows of where the money's, just show me the money kind of deal. So, consumers, that's the households, are sending their dollar bills to product markets to purchase, and the dollar bills flow into business firms. Business firm dollar bills are flowing to factor markets to purchase factors. But then there's also other flows. For example, consumers don't get to use all the dollars of their income for making purchases. They have to pay taxes. And they do transfer, there are transfer payments actually from government back to consumers and from one consumer to another, but we aggregate all that. Now we have some other players, if you will. So we've got international markets, international players. Imports would be flowing, dollar bills flowing from consumers to other countries. But then our exports, the payment for those exports, that's our export going to other countries. The dollars are coming into our economy. And that's true too in terms of flow of factors. So the international down there. And another important entity, I kind of didn't really allude to government, but I talked about it. Of course, that's a very critical entity. And then financial markets, that matches savers and investors. And that's really a source of financial investment by business firms so they can turn around and do capital investment, physical investment. So we can think about the different players again. So you have international players, you have households or consumers, you have governments, and you have business firms. Another way of thinking about the circular flow is by thinking about leakages and injections. And for the circular flow not to be getting smaller or getting larger, leakages have to exactly equal injections. So, for example, in terms of talking about leakages, when consumers are buying goods that are produced abroad, those dollars are leaking into or out of, I should say, our domestic economy into the foreign economy. But our exports to other countries, those dollars are being re-injected back in. When consumers save, that's this line over here, that's leaking out of their purchases. They're not currently purchasing goods and services, but those are re-injected by business firms in the form of investment. So in a circular flow where it's not increasing or decreasing, leakages have to equal injections. Now, again, more specifics about the U.S. National Income and Product Accounts. It's the Bureau of Economic Analysis that tabulates all this data. It's like national bookkeeping is really what is national accounting product. And here's my definition. It will vary with books, but I think there's some important elements here. GDP is the legal, notice legal, market value of final, notice final, goods and services produced in an economy over a given time period, such as a year. So GDP does not include things that do not move through legal markets. So illegal drugs, for example, would not be included in the calculation of GDP. It's also true that these are physical goods and services. So something like the sale of a U.S. bond, for example, does not get calculated into GDP because that's not a physical good. That's just a piece of paper, or it used to be. Now it's just the digital entry. So make sure you understand what GDP is and what it isn't. Now, there's different ways of actually totaling up the values of the different components to get to GDP. One is the value-added approach. We don't use that here in the United States. The BEA actually does keep those calculations, but that's not used too much here. It's used in countries that have value-added taxes, and I'm glad we don't, because that adds to layers and layers of taxes. But the two I really want to concentrate on is the expenditure approach and the income approach. Now, this relates back to that circular flow. The expenditure approach is looking at sales in the top part of the circular flow, the way I had it drawn. The income approach is looking at the payment for the factors of production in the bottom part. Now, this P times Q, this is kind of my own viewpoint of how you could think about it. This is actually what we'll see as nominal GDP. It's a price index value. We've already studied that, times, and we can, the quantity of stuff, but quantity, you can't add oranges and apples. So the way we're calculating the quantity is real GDP. So the price index value times real GDP gives you nominal GDP. If you go back to how you go from nominal to real, you also realize that if you take the real times the price index value in decimal form, you would get nominal. So that's just, to me, a logical way of thinking about things. So the expenditure approach, you can think of that as the different components. So C stands for consumer spending, that's households. I stands for business investment spending, and that's purchases of capital goods. That's not purchases of stocks and bonds and things like that. That's financial investment. G stands for government. X minus M stands for exports, and X stands for exports, M stands for imports. You'll see that written in various ways. We could also write that as XN for net exports. So this is looking at who purchases the GDP. And the BEA site is just bea.gov. And the tables I like to really look at, so table 1.1.5 and 1.1.6, just for your information. Another way of looking at GDP is to look at that bottom part of the circular flow. And so if we add all the incomes that are generated from the new production and sale of that new production, add those payments together, that would be wages, interest, rents, and profits, then we would also get GDP. And that's actually on table 1.10. Now, years back, we didn't use GDP, we used GNP, which is gross national product. And GDP is looking at production that occurs within the United States boundaries. That's domestic production. GNP, gross national production, that's looking at production by national companies. So, give you an example. When Toyota is producing pickup trucks down in San Antonio, that would be GDP because that is physically occurring, the production in the United States, even though Toyota is not an American-owned company. On the other hand, Ford has a small truck plant in Italy, and that would be part of GNP because Ford is an American-owned company, but it would not be part of GDP. Now, you can go from GDP to GNP by looking at the flow of the profits back and forth. And so that's called net foreign factor income. And so GDP plus or minus, for us, it's a plus, fortunately, net foreign factor income equals GNP. And then some of the new production is just to go and replace stuff that's wearing out, machines, capital goods is wearing out. So we subtract a consumption of fixed capital, that's basically the depreciation, and we get something called net national product, NNP. And NNP, net national product, and national income, top part and the bottom part, that's the two entities that technically should be the same. Now, because we're talking about massive data collection, those are never going to be exactly the same. And so we just make them the same because theoretically they should be. So that's the statistical discrepancy, just whatever number is necessary to make a match. Now, from national income, we can subtract transfer payments, inventory adjustments, and other flows not received as income. So this is stuff that's floating around, but no person is receiving as income in the United States. And then we add personal income receipts and personal transfer receipts. In other words, money transfer payments that we're getting from people in other countries, as an example. And that those adjustments give us personal income. But there's some important deductions that we have to make. Personal income minus personal taxes. Yeah, we have to pay those personal taxes. That gives us disposable personal income, or DPI. Sometimes I mix it and call it personal disposable income, but same thing. So disposable personal income, that's what you can spend. There's only two things you can do with your disposable personal income, your DPI. You either spend it or save it. I already talked about nominal versus real. And so nominal and real, the adjustments are exactly the same as any other adjustment from nominal to real. So nominal divided by the price index equals real, or nominal divided by the price index times 100 will give you real. So either way you want to think about it. Up here, all I'm saying is this is a decimal form. This is not a decimal form. Same formula. It's just whether it's shown as a percentage or a decimal form. Now, to get you a kind of an understanding of why we need to make adjustments, I've got this silly little hypothetical example. So let's say we have this tiny island country of Twinkie land, and it's a very small island. The only thing that they produce and consume, of course, they would die pretty quickly, but stay with me on this, are Twinkies. So last year they produced 100 Twinkies. Well, they are going to really starve. Those were produced and sold at $1 each. So GDP would be the dollar times 100, that'd be $100. This year, for whatever reason, fewer Twinkies were produced, 90, but the price went up. Well, that's kind of, supply and demand. And since we're talking about one product, but 90 times 1.25, $1.25, that's 112 and 50 cents, $112.50. Well, just in nominal GDP terms, so these both are nominal GDPs for the previous year and the current year one, if you will, and year two. It doesn't necessarily have to be consecutive. But we know that just looking at the numbers here that the actual production went down. And so what we have to do is adjust those nominal GDP values for inflation impacts for price changes. And so nominal GDP divided by the price index would equal to real. So you take nominal GDP in year two, 112.5. The price index would be 1.25 in decimal form. We're back to the 90. So I know that's kind of a silly little example, but there you go. Now, as I've alluded to in other videos related to macroeconomic measures, there are problems with GDP data collection. I've already mentioned the fact that things that don't go through legal markets aren't counted. It's also true that when there's an improvement in quality, that doesn't get calculated in GDP. So maybe something is twice as good, and maybe we only need half of it as much as we did of some other thing. But it would be like GDP has fallen because we're purchasing and using the purchase is the key thing, only half as many of those things. So it doesn't measure quality. It doesn't measure all goods and services. Now, something I didn't mention is it's newly produced goods and services. There are a few exceptions. One is at the end of a fiscal year for a business, any unsold inventory that the business has, that's considered an investment. And so it is counted into GDP. It's like the company has purchased that inventory themselves if it's unsold inventory. So I hope you can see that things kind of go along with the circular flow model, and very important to calculate GDP because as the circular flow model shows, it also is very much the same as our income.